Most people think picking an ETF is about finding the best one, but that's not really the question. The real question is what you want your money to do for you, because one ETF can turn $500,000 into a giant portfolio that barely pays you a monthly income, while another can create a steady paycheck but leave the account itself moving slower than expected. Same starting amount, completely different outcome, and that's what this video is about. John takes the same $500,000 and runs it through 5 completely different ETFs over the same 5-year period. One ETF is built for growth, one is built for income, one tries to balance both, another focuses entirely on technology, and one quietly owns almost the entire world outside the United States. By the end, you'll see exactly how much each ETF could grow, how much income it could pay, and which combination creates the most balanced result overall. Because most investors don't actually want the highest return, they want a portfolio that changes their life in a real way. John starts where almost everyone starts, the S&P 500, specifically the Vanguard S&P 500 ETF, better known by its ticker, VOO. If you ask 10 investors where to put a large amount of money for the long term, chances are most of them will mention this fund, and there's a reason for that. VOO, the 500 biggest publicly traded companies in the United States: Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta. If corporate America grows, VOO grows with it. There's no stock picking happening here, no manager trying to guess which company will outperform next year. The ETF simply tracks the market and lets time do the work. The expense ratio is tiny, around 0.03%, meaning almost every dollar John invests stays inside the portfolio instead of disappearing into management fees. On $500,000, the yearly fee is so small that most people would spend more ordering takeout for a month. But the real appeal of VOO is simplicity. This is the ETF people buy when they don't want to constantly monitor charts or chase trends. It's the definition of buy and hold. Historically, the S&P 500 has rewarded patience better than almost any other MAINSTREAM investment strategy. Over long periods, the combination of corporate earnings growth, innovation, and reinvested dividends has created enormous wealth for investors who simply stayed invested, and that's exactly what John wants to test. What happens if someone drops $500,000 into VOO and ignores it for 5 years? The answer is powerful. Assuming historical style performance continues, John's $500,000 steadily compounds year after year. By the end of year 1, the portfolio climbs to around $571,000. Year 2 pushes it past $652,000. By year 3, the account crosses $745,000. Year 4 approaches $850,000. And by year 5, the portfolio is sitting close to the $1 million mark, nearly doubling the original investment without buying individual stocks, without panic selling during downturns, and without trying to predict the market. Just one ETF and patience. But then John looks at something most investors ignore at first: income. Despite the account growing dramatically, the dividend payments remain surprisingly small. In year 1, the ETF produces only a few $1,000s in annual income. By year 5, the monthly income still feels modest compared to the account size. The portfolio became larger, but it didn't really start paying for his lifestyle. And that's when John realizes something important. Growth and income are not the same thing. Some ETFs are designed to maximize share price appreciation. Others are designed to send cash back to investors consistently. VOO clearly prioritizes growth, so John decides to look outside the United States. That's where VXUS enters the conversation. VXUS is Vanguard's total international stock ETF. Instead of focusing on American companies, it owns thousands of businesses across Europe, Asia, Canada, Australia, emerging markets, and more. Toyota, Samsung, Nestle, Tencent, Shell, and countless others all sit inside this single ETF. Most American investors barely touch. international stocks. But globally diversified investors know something important. Many international companies pay far larger dividends than US companies do, and that changes the experience immediately. ZUS doesn't grow as aggressively as VU, but the income profile looks completely different. International companies often distribute a much larger percentage of profits back to shareholders instead of aggressively reinvesting everything into expansion. That means investors receive more cash flow along the way. When John runs the numbers, the portfolio still grows steadily over 5 years, but at a slower pace than the S&P 500. Instead of nearly doubling, the account climbs more gradually, yet the dividend income becomes impossible to ignore. Suddenly, the portfolio is producing well over $1,000 every month. Not life-changing yet, but undeniably meaningful. Now the trade-off becomes clear. VU creates stronger long-term growth, but weak cash flow. VXUS creates stronger income, but slower appreciation. Neither fund is better. They're solving different problems, and that leads John to a third ETF that many dividend investors swear by: SCHD. SCHD, the Schwab US Dividend Equity ETF, sits in a completely different category. This fund doesn't simply buy every company in the market. Instead, it screens for businesses with strong financial health, reliable cash flow, and long histories of consistently paying and increasing dividends. Companies that fail those quality tests don't make it into the ETF. That means SCHD owns fewer companies, but the companies it does own tend to be mature, profitable businesses that reward shareholders directly. When John compares SCHD to the previous two ETFs, something interesting happens. The portfolio growth remains strong, much stronger than VXUS, and not dramatically behind VU. At the same time, the income generation becomes far more attractive. The monthly dividend payments rise steadily every single year because the underlying companies are increasing their payouts over time. This is what makes dividend growth investing so powerful. The income doesn't stay flat, it expands. By year 5, SCHD has transformed the original $500,000 into a portfolio approaching 7 figures, while also generating thousands of dollars per month in dividend income. For the first time, John feels like he's seeing both sides of investing working together. The account balance is climbing fast enough to build wealth, while the cash flow becomes large enough to actually improve everyday life. SCHD isn't the fastest grower, and it isn't the highest yielder, but it balances both worlds remarkably well. Still, John wants to see what happens when an ETF focuses almost entirely on income. That brings him to JEPI, the Morgan Equity Premium Income. ETF is built differently from almost everything else in this comparison. Instead of relying only on dividends, JEPI also generates income by selling covered call options on large US stocks. In simple terms, the ETF collects extra cash, premiums from investors willing to bet on future stock price movements. That extra income gets passed directly to shareholders, and the numbers become shocking almost immediately. JEPI's monthly income dwarfs every ETF John has looked at so far. Suddenly, the portfolio is producing thousands of dollars every single month, enough to resemble a full-time paycheck. By year 5, the income stream becomes massive. The ETF essentially transforms investment capital into cash flow. But there's a catch. While JEPI excels at income, the account balance itself grows far slower, because the strategy sacrifices part of the upside during strong market rallies. The portfolio appreciation lags behind growth-focused ETFs. John realizes that JEPI isn't designed to maximize wealth accumulation. It's designed to maximize cash distribution. This is the type of ETF retirees often gravitate toward, because it prioritizes income over aggressive long-term growth. Then comes the final ETF in the experiment, and this one changes everything again. VGT, Vanguard's Information Technology ETF, represents the opposite extreme from JEPI. This fund is almost entirely concentrated in technology companies: Apple, Microsoft, Nvidia, Broadcom, Adobe, Oracle, Salesforce. Instead of diversification across every sector, VGT goes all in on the idea that technology continues dominating the modern economy. The growth projections are explosive. Over 5 years, the account doesn't just grow, it surges. The portfolio races past $1 million and keeps climbing. By the end of the test period, John's original investment has nearly tripled. None of the other ETFs even come close. But once again, the income side tells a completely different story. Despite the massive portfolio value, the dividend income remains tiny. Technology companies rarely pay high dividends because they prefer reinvesting profits into research, innovation, acquisitions, and expansion. So while the account value becomes enormous, the monthly cash flow barely changes. At this point, John finally sees the full picture. Every ETF in this experiment is excellent at something, but terrible at something else. VOO creates broad market growth. VXUS creates global diversification and higher dividends. SCHD balances growth with rising income. JEPI creates immediate cash flow. VGT maximizes aggressive long-term appreciation. None of them alone fully solve the problem. So instead of choosing one ETF, John builds a portfolio using all 5. He gives the largest allocations to SCHD and JEPI, because together they provide the strongest balance between growth and income. VXUS gets a meaningful position for international diversification and stronger global dividends. VOO becomes the stable foundation, quietly compounding in the background, and VGT gets a smaller allocation to inject powerful, technology-driven growth potential into the portfolio. The result is something much more balanced than any individual ETF could provide alone. The account still grows aggressively over 5 years, but now the income stream becomes large enough to matter in real life. Instead of chasing the highest possible return or the highest possible dividend yield, the portfolio combines multiple strategies working together. And that's the biggest lesson John learns from this experiment. Investing is not about finding the perfect ETF. It's about understanding what each ETF is designed to do. Growth ETFs build wealth. Dividend ETFs build cash flow. Technology ETFs amplify upside. International ETFs diversify risk. Covered call ETFs generate income. Once you understand that, portfolio construction becomes less about hype and more about purpose. Because at the end of the day, a portfolio isn't just a number on a screen. It's supposed to support your future. Maybe you want financial independence. Maybe you want monthly passive income. Maybe you want long-term growth for retirement. Different ETFs solve different problems. And the smartest investors stop expecting one ETF to do everything perfectly. That's why John's final portfolio works. Not because it beats every ETF in every category, but because it avoids depending entirely on one strategy. When technology struggles, dividend income still arrives. When growth slows, global diversification helps stabilize returns. When markets rally, growth funds accelerate the portfolio. The portfolio becomes resilient instead of extreme. And for most people, that's probably the real goal. Not winning one spectacular year, not chasing the hottest sector,